bit of perspective on the markets as we head into the CPI report tomorrow. That's coming up on 3 Minutes on Markets and Money. While the market certainly feels like we're in a bear market after the decline so far this year, actually markets still remain in a very bullish trend longer term. And if we take a look at the markets going back to the financial crisis, the 200-week moving average has been a very consistent kind of rising bullish trend line. That has not changed to this point. The market is currently testing that support right now, so it'll be important for markets to hold on to that 200-week moving average. This is kind of the line in the sand between a running bull market trend and a bear market. A bear market is not just a 20% decline in price. It's kind of just a random arbitrary analysis that used to apply to markets, but because of all the stimulus that we did in the markets, the deviation between the market and that long-term moving average became so great that we had to have a bigger reversion just to come back down to that running trend line, which has repeatedly been the case really ever since the financial crisis lows. We've retested that 200-week moving average multiple times along the way, and we're doing it again right now. So in order for us to actually be in a technical bear market, we're going to need to have a violation of this 200-week moving average that is confirmed. In other words, markets start to trend lower. Now, that's certainly possibly the case with inflation, slowing economic growth, decline in earnings, etc. But markets have been doing a lot of work here to rebalance that risk that was built up in the markets. Again, that massive deviation just took a whole lot to work off. And so while this feels like a bear market, and a lot of people are treating it that way, and there's nothing wrong with that, what we are saying is that the market still remains in a very bullish trend longer term. And this is how the Federal Reserve is also looking at the markets, right? The wealth effect is still in place. So while there's a lot of hope that the Fed will pivot and start to bail out markets once again, if you take a look at where the markets are currently, markets are still above where we were at the peak of the market in February of 2020. So from the Federal Reserve standpoint, the market is still in a positive trend. The wealth effect is still positive. So this is why there's not a huge amount of worry right now from the Fed relative to the markets, because again, that wealth effect is still intact here. So while we often measure our performance from the beginning of the year to where we are currently, and again, there's a bit of faultiness to that analysis and gets us trapped into a lot of psychological issues of, panic selling, doing the wrong thing with our portfolios. If you start to look back just over very small periods of time, markets are still substantially higher than where they were just even a couple of years ago. So from a financial standpoint, the way the Federal Reserve looks at this is there's not a lot of risk in the markets. Financial instability isn't really an issue from the stock market perspective. Now, from dollar swaps and what's happening overseas, there's certainly some cracks appearing in both the credit markets as well as the dollar markets as well overseas. And we're starting to see the Federal Reserve pay more attention to those cracks within the credit markets that are forming. But from a financial standpoint, the markets themselves are not a huge problem at this moment. So again, that can certainly change as we get into earnings season. This is going to be really critical. But importantly here, for investors, pay attention to this 200-week moving average, because this is now the line in the sand for the markets. A break below that, a retest and failure will suggest lower prices as we move into next year. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.